I'm Zakiya Smith, the Director of Finance and Federal Policy here at Lumina, and have been really excited to partner with IHEP on these films. Thankful that many of you have found them useful, and I'm really excited about the last film in this installment, which seems really timely given the issues that were raised today, frankly, in the report that CAP released that Jamie mentioned earlier, but that I think have been on a lot of people's minds about student loans and their role in federal policy, and particularly the extent to which different repayment paradigms can really help people manage student loan debts better. So before we get into the second panel, we will preview that final film here, which is probably live on our website now, but we're going to have a chance to view it. It's short, as are most of the films, and then directly after that, we'll have a panel discussing. Thanks.
Loan repayment and forgiveness is this idea that we could provide options on the back end for students.
There are certainly a variety of repayment plans that student loan borrowers can select once they exit school.
Income-driven repayment essentially involves borrowers paying some kind of affordable percentage of their income towards their loan.
These income-based repayments are supposed to allow students who may have gone into low-income paying jobs, if they borrowed a lot of money, they can only pay back a small percentage of their income.
Income-based repayment plans, even from the beginning in the early 90s, include a loan forgiveness provision, which is after a set period of time of making payments based on your income, if you still have a balance after that, that amount is then forgiven, so you no longer owe the debt. The idea here is that it's a loan, it has a balance, and it's charging interest. And so if you're paying based on your income, you aren't really paying on the loan in a manner that is guaranteed to pay off the loan. And so someone who has a large balance and a low income could find themselves essentially paying forever.
The National Defense Student Loan Program was enacted in 1958, and it provided students who demonstrated financial need an opportunity to get a low-cost loan and have the opportunity to repay it over a period of 10 years. At the same time, it included a provision that enabled students to have their loans canceled up to 50% of their loan over a period of time if they chose to go into teaching. Teaching being a national need at the time. That program in the large context is the framework for almost all the student loan payment and forgiveness and programs that we have today. In 1965, as part of the war on poverty, Lyndon Johnson created what we call the Guaranteed Student Loan Program. People were focused on making the capital available to the loans without giving a whole lot of thought to making it reasonable and easy for borrowers to repay their loans.
We had essentially what became known as the Federal Family Education Loan Program, or FFELP, as sometimes people called it. It used to be the Guaranteed Student Loan Program, or GSL.
During the late 70s, people began talking about options such as income contingent repayments and other alternatives that might be possible within the loan program. It was soon discovered that in the guaranteed loan program, those options weren't feasible to do, simply because you had so many players. You could really only make something like that work with a direct type loan program.
Mr. Petri was the main proponent in the 1980s of income contingent student loans. Under the Petri bill, with collection by the IRS as part of income taxes, there was no need for any outside private sector servicing of loans. In addition, there's no real role for banks in signing up students and no need for them to provide capital. Therefore, under the Petri bill, it was logical to have direct lending in which the government provided the capital and collected on the loans through the IRS.
In the late 80s, early 90s, as we went from the Bush administration to the Clinton administration, we started experimenting with a much wider expanse of what became known as direct loans, and that experiment turned into what we now call the Federal Direct Student Loan Program, where all the loans now, the schools and the federal government, there are no lenders involved with the federal program.
Clinton took that on as one of his campaign planks to create a direct loan system, allowing people to repay their loans through national service or as a percentage of their income.
Republicans who backed the P-TRI bill were willing to go along with that.
We really emphasized that borrowers would have a choice about how to repay, and they could change that choice over time. So they would have the ability to repay by the standard 10-year repayment mechanism, by an extended period that might have you repay over 12 years, or the graduated repayment mechanism of smaller payments in the beginning and larger payments later, or through what we called at the time income contingent repayment.
With the whole focus on defaults and how we could reduce defaults and how we could encourage students to get into repayment more quickly and in a way that would reduce defaults, income contingent repayment just seemed like a good solution to a potential major problem.
And it was really the first option in the federal loan program that allowed borrowers to tie their payments to their income.
At the time, we were very concerned that income contingent repayment not provide an incentive or encourage people to overborrow. The specifics of what the parameters would be for that, what percentage of income would be repaid, how it would vary, those parameters were developed through regulation.
There was a lot of discussion over how you would do the income ladder. In other words, what income levels would you reach to pay a certain percentage or a certain amount of your loan, and then what was the amount at which you would only pay a token amount.
During 1994, there was a series of negotiated rulemakings between the Education Department and all the interested parties from the education community as to the design of the repayment table. And eventually, the Education Department adopted something very similar to the P-TRI repayment table. Very graduated system of income tax brackets that rose as your income rose. And there were different brackets for married couples, single returns, married filing separately, and head of household.
So what you ended up with was a situation where if you were a direct loan borrower, you could get the full range of repayment options, including income contingent. But if you were in the FFEL program, the income contingent repayment option wasn't available to you. And that was a real issue because you wanted all borrowers to be able to have similar repayment plans. So in 1998, legislation was enacted to give FFEL borrowers as much as possible similar repayment options as direct loans. And something called income-sensitive repayment was added where you could work with your lender and have a income-sensitive repayment plan. It wasn't the same as the income contingent repayment loan, but it was an attempt to give borrowers in the FFEL program something fairly similar to the income contingent repayment.
Over time, the income contingent, income sensitive repayment plans, the extended graduated plans were still seen as not expansive enough to accommodate as many borrowers.
The income-based repayment program was created under the College Cost Reduction Access Act in 2007.
Many might wonder if there was an existing income-based plan already in law, why did Congress create a new one? The issue is that the income contingent plan was more limited. It was already limited to just borrowers in the direct loan program.
The
income-based repayment program was a major improvement because it applied to all the student loan programs.
The biggest difference between income-based repayment and income contingent repayment is mainly the terms. Income-based repayment is a little bit simpler. The borrowers have to pay a smaller percentage of their income. In 2010, Congress made changes to the income-based repayment program through the Healthcare, Education, and Reconciliation Act. That legislation made income-based repayment more generous.
We were negotiating both the move to direct lending as well as the allocation of resources for programs like income-based repayment.
They didn't have enough money, quite frankly, to make all loans eligible for this new income-based repayment plan with a lower monthly cap and forgiveness after 20 years. So given that they didn't have enough money, but they wanted to improve income-based repayment, they created income-based repayment that would be available to all borrowers who were first-time borrowers in 2014.
So that created a long lag as to when the program really would start to take effect, right? New borrowers as of 2014 means people were taking out their loans around now. They may not go into repayment until 2017, and that's when you would start to see the effects of the program.
So that became the third repayment plan. The fourth repayment plan became when the president felt like people were struggling with repayment given the recession. They wanted more borrowers, and particularly borrowers who were entering the economy during the recession, just fresh out of college, to be able to benefit from the lower monthly payment cap the president had proposed and the earlier forgiveness he had proposed. So there, the administration went back to the income contingent repayment program and realized they could amend that through regulatory changes to effectively make current new borrowers who are just entering the market with undergraduate degrees eligible for those more generous benefits. So that led to the creation of what is now called the Pay-As-You-Earn plan.
The Pay-As-You-Earn program was an attempt to include more students, those students that were left out of the legislation in 2010. And then the president realized that this was confusing, that some groups of borrowers were able to take advantage of better terms, but some weren't. Loan forgiveness and the repayment programs are designed to make sure that the dream doesn't turn into a nightmare, that you're saddled with so much debt that you're unable to pay it and you end up defaulting. The issues center around whether we have it right, whether we're providing the kind of tools that students need to better manage their debt, to avoid default, while still having the primary responsibility for repaying the bulk of their loans.
There's certainly a lively debate about what the terms of income-driven repayment should be. These debates are probably going to continue, and really they come down to how much protection do we want to offer borrowers, but on the other hand, we want to make sure that borrowers still have incentives to borrow prudently and that we don't take pressure off institutions in terms of keeping tuition in check.
The core issues with loan repayment over time are really trying to figure out, as with a lot of other things in higher education policy, we create wonderful programs, but how can we make sure that as we are developing repayment programs over time, is there a way to look at them and aggregate and consolidate them and make it simpler for students and families to take advantage of? And that's always the struggle and balance in federal higher education policy. We create really good opportunities and programs, but can we also be taking the step back and look at how do we enhance that and make it simpler for students and families moving forward?
You're supposed to be at the very end. Yeah. And then you're next to James. And then you're next to me. Okay. All right. Okay. Now I can experience the bright lights, but I am well oriented to who's who, and will call out people as I want to do. So thank you guys for coming again. And now we wanted to talk specifically about the final film and within the context of what's going on today. I think the retrospective film, the retrospective panel, and the earlier kind of trailer give you a sense of the totality of the films really talk about these trade-offs. But right now, we're in a particular time where people are thinking about repayment of student loans, and there's a lot of conversation about the best way to structure some of these programs. And you heard through the film kind of the history of even from the Clinton administration and through different iterations in Congress and some administrative actions of the Obama administration's ways that these programs have been changed over time and really, because of the nature of student loans, just tacked on so that we have kind of a panoply of options now in a way that may not be the simple design that we may have thought would be the best way to do this. In addition, we also have some new conversation about income share agreements, which are I feel like every other week we get an email from someone wanting to talk about this new thing that they heard about, which are similar to the concept of income-driven repayment options, but not the same. And Kevin James, who's here with us, can talk a little bit more about that. He worked for Representative Petri and also now works on income share agreements full-time in a context that he can describe a little bit more later. So we wanted to bring it into kind of what's going on today. In addition, we've got with us Angela Boatman, who's assistant professor at Vanderbilt University, but who's also done some research on how students view different types of repayment options. Because one of the things that we found at Lumina that a lot of people kind of assumed was that having better options for repayment, more flexible options for repayment that were driven, that were linked to income would make it more likely that people would take out loans and that it would make it more comfortable for people to take out loans. And that was really a hypothesis that has been tested somewhat internationally, but not so much research. So Angela has done some research on specifically that topic, which, full disclaimer, Lumina funded. But I don't really, have any bones one way or the other, just wanting to know the answer. Like, I don't make more money if one or the other happens. It would be a lot easier if you had those kind of clear directives, right? And then James Quall, who is now executive director of the college movement, but also has many former lives of his policymaking expertise. One of the most recent of which was as deputy director of the Domestic Policy Council in the Obama White House, and has worked on some of the more recent versions of income-based repayment and some of the repay and pay and all of the administrative steps, and can also potentially talk about some of the history of this going back as far as the Clinton administration, which is really not that long ago, right? So to jump right into things here, I really want to start with talking about the successes and challenges of these programs over the past few decades. Just from each of your perspectives, you kind of seen the different iterations of the policies and what has worked well and what has been a challenge that persists. You can go in any order. I'm looking at James, though, so I'm going to start with you.
I'll start. It feels good to be the old person on this panel. And although I don't have the fancy title, I am a has-been. So, I think that when we first started talking about the creation of these programs, we actually thought that people were defaulting on their student loans because they couldn't afford it. And so, we actually thought that the creation of income contingent loans had the potential to completely eliminate student loan default. And I think that, there is a lot of merit in the idea of what we were trying to do, where I think we tell people consistently that going to college is one of the best investments they can make in their futures, but we know that some 40% of students don't graduate, that even among students who do graduate, earnings vary widely. There's potential for a medical accident or something else that may mean that we want people borrowing to invest in themselves, but we also want to provide some insurance to make sure that it doesn't end up leaving them worse off. I think secondly, and this seems particularly appealing to the politicians, is the notion that people who go into public service are getting a raw end of the bargain, and that student loans are justified by the high earnings of college graduates, but maybe that's not true if you're a teacher or, especially early childhood worker or something like that. And so some additional level of subsidy on student loans is an equitable adjustment to our college financing system for people engaged in public service. And I think politicians like that maybe is a sign that is a little more intuitive to regular people, or they understand that a little better than the Milton Friedman economics argument. So I think there's merit in those approaches, but I do think in terms of what's left undone, we have not paid nearly enough attention to how this works in practice, and the incentives that our contractors have, the difficulty of certifying income, the difficulty of communicating with borrowers. And so, in a situation where we have, on paper, solved the problem of student loan default, where everyone or virtually everyone should have a student loan payment that's affordable, whether through one of the income contingent plans or through forbearance or deferment, we still have 1 million defaults. So there's something clearly going wrong there in how we communicate with borrowers. And then, lastly, I'll say, the question of simplicity, and having listened to the first panel and then watching the video, I was kind of ticking through in my head, like, oh yeah, we had to create another plan there because of budget constraints, and then we couldn't revisit because it was statutory, but we, and then we didn't want to get rid of that one because there were a few people who were still better off. So, there was like a reason that made sense at the time for the proliferation of plans. But we're in a situation now where it's very, very confusing, even for those of us who worked on creating them, to keep them all straight.
Does anyone else want to take a crack at what some of the challenges and successes have been over time from these different programs?
Yeah, I'll just echo much of what James said. I mean, I think the success has been in a recognition of the importance of income-driven payment options generally. We are asking people to make what is essentially, for most of them, probably the second biggest investment that they'll ever make in their lives, probably second to buying a house. But in this case, they're doing it with no collateral, with no sort of guarantee that this investment is going to pay off for them, and no ability to sort of sell the house if things go badly. And so that's a problem that's particularly acute for low-income students who both need the financing and don't have sort of the natural social insurance that comes from being in an upper middle-class family. And so I always felt, I started this working for Congressman Petri. When I started as a legislative assistant working for him, I didn't realize sort of the flow of history that he had sort of already started on this decades ago. When I first started, or as I'd gotten working on this, I found an old typewritten FAQ document from 1983 when he had sort of introduced the first income contingent loan bill. So he certainly deserves credit, but I think he believed in his bones, and I do too, that this is the right way for students to finance their education on top of grants and other things like that. I think also to echo what James said, we've been hamstrung a little bit in this country because we had so much infrastructure developed decades ago, all of it built around traditional loans. And so we've really sort of built on that piece by piece, all with good reasons at the time, but it's made it very difficult for an idea that is as much about program design and administration as it is about terms. It's made it very difficult to build something that's clean, and some of the other countries that did this, they did it decades later, and they just sort of built something from scratch where they had no loans before, and it made it much simpler for them. So I just think we all recognize the need to improve the design, but I think it's been a challenge, and I know lots of people in this room have put a lot of time into just piece by piece making the design improvements that are necessary to make it better.
I think I would pick up from this idea of sort of what do we still need to know, or what questions are out there, less about the actual implementation of the policy and more about student behaviors, student perceptions, attitudes about borrowing money. I think these are still questions that run in parallel to these conversations about how to design the right policy. This is the work that you were highlighting earlier, is a lot of what I've been thinking about, along with two of my colleagues from Vanderbilt for a couple of years, is trying to fill in some of these holes around how students perceive borrowing when they are in high school? How does that differ from students who are currently enrolled in college? And how does that differ for adults? To Jamie's earlier point on the panel, I think there's still a lot to be learned about how people not only perceive borrowing, but how they also perceive repaying things that, money that they may have borrowed for education. And so I think those are still some questions that are important ones to be answered in this puzzle. If there is this phenomenon known as loan aversion, and some people are unwilling, they want to invest in higher education, and they may be unwilling to do so because of risk, because of repayment, because of prior experience in the credit market that went badly for them. Are there ways that can be addressed, and who are we talking about when we talk about that phenomenon? Which groups of students or potential borrowers, I guess? And so we tried to do a lot of work around getting a more complete picture of that in the United States. So looking at high school students, adults, and students currently enrolled in college to see if there were differences in their attitudes and perceptions about borrowing. And I'd be happy to talk more about that.
So, as I'm going to just jump right in and take that opportunity, then I'm kind of struck by, there's certainly probably some loan aversion, which I want you to kind of talk to us about. But then seeing the stats from today of some folks who have loans who can't repay them, there's certainly the ability of, it's interesting, I think the idea of income-driven, and I'm using the term income-driven payments because they could kind of maybe apply both to income share agreements and kind of traditional loan structures, but the idea of being able to finance your current costs with future earnings, you could potentially, in theory, if college didn't work out for one reason or another, you would be buffered from that. And so you shouldn't necessarily have the concern about defaults that we're seeing, but yet we still do. And on the other hand, if you're worried about taking on debt, this maybe should help you kind of mitigate those concerns as well. But I'm wondering, kind of, what do you see among students of all types and how they perceive those different types?
I think that was the very motivation for a lot of this work, was to see if there are differences in attitudes or perceptions about borrowing. Can we sort of try to explain some of the mechanisms of where those might come from? Are there interventions that could be put into place that might address some of that? This work was not inherently sort of pro-loan. We didn't go into this saying more people should take out loans, but we were interested in this group that felt nervous about loans, and are there ways in which we could better understand some of that anxiety in a way to see if there were parts of that could be addressed, and really with the important goal being to help people to make an investment that would be the right one for them, right? So we know there's the returns overall on the aggregate, but what is the right decision for an individual? I think a lot of that has to do with their attitudes about borrowing as well as their parents when you're talking about young people. So what we did is we surveyed about 6,000, a little over 6,000 people, randomly selected high schools in 4 states. We looked at seniors in high school, and then we also looked at a sample of community college students from those same 4 states, and then we found a sample of adults that had not attended, they did not have a college degree, they had not attended college, but were potentially interested in returning to college, which we know to be, I come from I'm living in the state of Tennessee right now. This is a big population that state is very focused on, is trying to get adults to return to college to finish a credential. So 3 distinct but important groups when it came to loans. And we asked a lot of questions about willingness to borrow for lots of things, education being one of those things. And we were curious if those attitudes about borrowing differed by both demographic characteristics, so first-generation college student or race or the different age groups, but then also by other things like financial literacy or knowledge of the federal aid system, or prior experience in the credit market. So if you had prior experience in the credit market that was negative, did this make you less, did you have different attitudes about borrowing than folks who hadn't had that? And so we generally did find differences we find that loan aversion does exist, right? There are people for whom they are very averse to borrowing, and that there are differences by some of those groups that I described. And we see the largest levels of loan aversion among Hispanic students, as well as women reported being statistically more likely to avoid being more loan averse. But what was really interesting is that we also saw this relationship to things like financial literacy and knowledge of the federal loan system. So we took that information and actually did an experiment in a school district in Kentucky where we provided students with information about the federal loan system, and the control was just information about financial aid generally. But the treatment experiment was actually targeted towards income-based repayment, talking to students in high school about income-based repayment. Do you know that when if you have to borrow money for college, that you can tie this to your income, which would reduce the chances of bad things happening and defaulting on your loans. So just like this sort of short information intervention. And we actually found these positive effects on informing young people about this option when they were still in high school, but long before they'd even decided, not long before, but shortly before they decided to borrow or attend college, which sort of has now got us thinking about tracking those same students to observe actual borrowing behaviors and thinking about whether or not this leads to more positive outcomes for students if we shift, as the last panel talked about, some of that education to the front end. And we think more about financial literacy and knowledge of federal loans as being an intervention we could implement earlier on.
Thank you. And one of the ways that this is kind of, and we should talk a little bit more about implementation, because I think that is one of the things that you can kind of give people better information, which we currently don't do a great job of telling people about these different options. But the way that these programs are implemented can apparently, it seems, have an effect on how students take them up. And although there's a lot of conversation about income share agreements right now, they're different than income-based repayment, which is based on a set loan amount and kind of, still amortized over time. So I'm wondering, Kevin, can you talk a little bit about income share agreements? And they're happening right now in places. And so can you just talk a little bit about what they are and how they may be different and what you're seeing on the ground?
Yeah, so income share agreements are ISAs. They come from really the same kind of intellectual history as income-driven repayment. The concept is that you pay for a fixed amount of time and you pay a percentage of your income for that time, and so your obligation is really, there's no real balance or interest rate that you have. You're just sort of paying a percentage of your income over the time, and so what you truly pay just depends on what your income is during the payment term. And there usually is some kind of floor, so maybe it's $20,000 or $30,000 under which you have no obligation when you're earning less than that amount in those years. And there's usually some kind of cap that if you end up just becoming Mark Zuckerberg or something like that, you're not forking over $1 billion back to this fund.
Although that could be a positive outcome, maybe?
Yes, it is a positive outcome. You could build funds that way that are extremely progressive.
Yes. Okay. Just a thought. Go ahead.
No, it's not a crazy thought. There's interesting ways to do that. But I mean, the idea, I sort of started working on ISAs when I was working for Congressman Petri, and it was because we worked on the income-driven repayment process so much. And I realized, oh my gosh, I could spend years of my life on this and get this all sort of, with everyone else involved, we can get it all figured out. But then there's this whole other expanse of private loan market and Parent Plus and other things that don't offer these protections and that students also depend on. And so I was intrigued by the idea of being able to create sort of a separate space of income-based options sort of to complement the federal ones so that students would always have a full set of income-driven tools at their disposal when they needed them. And so I think what you've seen in the landscape since then is a variety of programs that sort of fill in those gaps. So one is Purdue's program called Back a Boiler, where Purdue created an ISA fund right now for sophomores, juniors, and seniors to kind of fill in the gap for private loan as an alternative to private loans and Parent Plus loans. You've also seen probably the most ISA activity in kind of the boot camp sector, which is not, for the most part, eligible for Title IV aid, and so it's a natural area where you would see kind of a new source of financial aid evolve that offers us income-based protections. And Zakiya mentioned the work that I'm doing. I created a nonprofit called Better Future Forward, and the idea was that from my perspective, the populations that can benefit the most from this idea are disadvantaged students who both need the capital and need the protections. And from my perspective, they also need high-quality educational pathways, whether they be workforce programs or traditional college programs. And what Better Future Forward was we specialize in deploying ISA funds in ways that open doors
to those high-quality pathways to help students get through them without debt or anything like it. And so let me just explain this very quickly by way of example. Our first program was this summer with a group called College Possible in Minnesota. They offer mentoring and coaching to low-income students in high school and college. And their students are 4 times more likely to graduate than their low-income peers. So they, wrapping around some of the programs, the public and nonprofit programs we're working with, form this high-quality pathway that we wanted to work with. And so we built an ISA fund for their students at 12 public and nonprofit universities. And so they can then work with their students as they're talking about financial aid. They can say, College Possible student, I know you have a remaining financial aid gap. Here's an option with our nonprofit partner that you can use to help fill that gap. And it's gone very well so far. We exhausted the fund, and the response from students has been very good. So I'm happy to talk more about it, but that's, to me, I think ISAs can be a useful and potentially very beneficial addition to the landscape for a lot of these students.
I do just want to add, one of the things we learned in some of our work was through some of these random assignment surveys that we see that the way that things are labeled matters a lot to people, which is, this from your the financial aid forms, and sort of how things are laid out, and that people respond differently depending on what you call things. And so people do respond negatively to the word loan. And so I was thinking of this when you were talking about this range of options, right? So when presented with 2 financially equivalent offers, we saw this large increase in the number of students that are resistant to the same offer, but one of them's labeled a loan and the other one is not.
That's fascinating, just because you would think, if it's the same terms and people see that it's the exact same terms, they should be equally willing to go forward. But because of the history, some of which we've seen here, there's now kind of this negative perception of the word loan, and I think student loans in today's society just have this really weighty negative feeling. And it's just personal anecdote. Some of you have been subjected to stories about my grandmother, who I hope is not watching right now. But she went to college in 1953, and there were generally no, we didn't have the student loan program that we have today. And so she went to college on a scholarship, like most other Black women who went to college at that time from a small town in South Carolina. If you didn't have any money, because her parents were sharecroppers, you didn't have any money, you had to go to college on a scholarship. And she was like, wow, if somebody had been willing to give me a loan, I wouldn't have had to do all this, I would have had so many more options. And so the thought that, student loans, at a certain time were truly an expansion of opportunity for people who might not have other means to finance, in the same way that if I didn't have the ability to get a loan for my house, I'd probably just not have a house, there wouldn't be some other things. So it's really interesting how that has changed over time. But one of the things that the reason some of that perception has changed is because of the way we implement collections around student loans for a variety of reasons. And as we've talked about I think some of the devil has been in the details. And so I want to talk a little bit about the details of implementation. And a lot of folks, I think, with income-driven repayment options look to Australia and the UK as models for how you might kind of develop a truly income-driven repayment system. But they have somewhat a different collection system that's fairly automatic. And so, James, you start us off with talking about why that matters, or how that might be different from what we do here.
Yeah, I think it's a really important question. So you do have the policy questions about what the formula should be. Mm-hmm. And people, I think, sometimes pay a lot of attention to that, and we're having a big debate about that now. But I think really the big difference with what the other countries are doing is the mechanism by which those loans are administered. And so, you could imagine here a student loan program that was fully integrated with the tax system. And that would be different in a number of ways. First of all, that the paperwork required for students to verify their income is quite significant and burdensome for them, and they essentially have to go through the same process that you would go through when applying for a mortgage or verifying your income for any outside entity. 2, that has to happen every year. So a year later, you've been in a program, it seems to be working well. You get these emails from your servicer telling you have to go through it again, and a very large numbers of students fall out of income-based repayment at that point. They see a big jump in their monthly payments, experience payment shock. I think thirdly, an ideal system, you would have payments based not on last year's income, which is you get out of the IRS, but you would get it based on your current income. So if you were unemployed, your monthly payments would automatically go down. And if you got a raise, your monthly payments would automatically go up. And that's a feature of Social Security or some of the other things we do through payroll tax system. That's not a feature of the income-based repayment system. And then, lastly, from a perspective of program integrity, the alternative documentation process, just doesn't have the same rigor that we use for income tax collection. Now, there's a bunch of downsides from structuring it this way as well. I think that, first and foremost, people often think that they have a little bit of flexibility with student loan payments, and so you might be able to skip a payment if you're having a tough month and your heat is not going to get turned off. There's quite a bit of complexity on the back end. If you're integrated with the tax system, presumably, you have people that have multiple jobs or have income off the books, and so you would ultimately need to reconcile it all through the tax system in the way you do income taxes. And that would require rethinking the definitions of the plans yet again to try and get stuff like household and definition of income and all that stuff aligned with the tax system. So, it's a heavy lift, but it would be, a fundamentally different way of thinking about student loans. And, I think that one lesson of the past couple decades, and not just income-based repayment, but also FAFSA simplification, where we tried to build relationships with the IRS, and all the interactions between the tax code and federal student aid policy, where Pell Grants are taxable if they're spent on one thing, but not if they're spent on another thing. And it's very difficult for students to figure out how to allocate their expenses between the tax credits and the Pell Grants. And by the way, your loan forgiveness is taxable in some circumstances, but not in other circumstances. So, our efforts, to administer these programs across two very different agencies to completely different sets of policymakers has also created a lot of disconnections that don't serve students well.
So when we think about simplicity, we talked a little bit in the last panel about simplicity, and that was a theme. And I've been reflecting a little bit on, and this was not a question that I gave you guys in advance, so I'm sorry. I just thought of it as James was talking. But when we talk about simplicity, we tend to talk about simplicity for the policymakers. Like, oh, there's so many programs to administer, can we just have one program? And when I think about what the borrowers are experiencing, it's really the simplicity of being able to use the program. So is it automatic? You could have one program that still sucks to sign up for because you have to print out a paper copy and then sign it and then fax it in to someone, and that would not be simple even if we had a reduced number of programs. And so what I'm just wondering about is and we don't have to figure this out now, but it seems like there's a difference between simplifying the program requirements and making it easy for people to understand, which is definitely beneficial in some ways, from the implementation of the user experience of the program. Once people are actually in it, how does it appear to them? Does it basically happen automatically? And I'm not sure, from the work you all are doing in the income share agreement space, is there the collection, or I don't want to say collection, it sounds so bad, but the how people end up, paying part. Have you all figured out a better way to do that than maybe our servicing system right now, which is notably complicated?
So I'll agree with the basic premise totally, that the federal aid system could use a massive design team that specializes in user experience research and really sits down with students to understand how this looks, because I did a lot of work on the payroll withholding kind of notions that James was talking about, and I agree with everything he's saying. I think these programs have been built up in ways that there was always reasons for it, but even little things like Jason Delisle tweeted about this the other day, we name the loans after people, and there's probably better ways to do things like that. And so, yes, I think it's just we have to really think through like how the experience works for students. And on the ISA side, I think there's probably not been enough experience in the U.S. to really like say that we've done everything better. I think there's things we can learn. I mean, what James said about like basing the obligation on your current income rather than your past income is one that can really help. It just makes it sort of aligns the income documentation with the existing infrastructure around that. And in the future, if you wanted to do payroll withholding, I think that change facilitates a lot. But then I think, honestly, I think there's going to be a lot of work about really subtle changes to the process in terms of, I mean, that was one thing in thinking about design thinking. It's often sort of a humble process in the sense that you present things to users and you ask them to respond and you sort of adapt the system over time based on what works for them and what doesn't. Whereas the process here tends to be, a lot of policy wonks sort of talking very divorced from users and trying to and come up with things that are going to work for them.
How many, well, I shouldn't ask that. I won't do that. I was going to ask how many people are current users of the income-based repayment program right now, so we can just talk about it.
Be able to see if...
I know. I couldn't see for the lights. We're going to go into audience Q&A shortly, I think. But I have a couple more questions. So I'm saying that now so that you can be formulating your questions for the panel, and I won't see them on Twitter later. I need to know them like right now so that we can do this in real time. One question is about kind of price sensitivity, and one of the and kind of institutional accountability for costs or outcomes. So on a very basic level, there's been a kind of policy wringing of hands about if our current accountability systems, which are mostly based on cohort default rates. I mean, there's gainful employment aside, but the ones that apply to everyone around cohort default rates. And those can be managed with, creative use of income-driven repayment. So that's one thing. I mean, I think that's not a reason to make people's, payments better, but it does present a clear and present kind of problem with the way policy was designed to work. And then there's another question, there's a related question of, do we think that these kinds of programs can kind of exacerbate the third-party payer problem that we have with student loans, where you're not really seeing what it really costs for programs in a way that, particularly coupled with forgiveness, could allow students to borrow and institutions even to, dare I say, game the system a little bit. There's been it's amazing that, I don't know if Jason is tweeting about this, but obviously he's written a lot and thought a lot about whether graduate schools are taking advantage of the kind of interaction with Grad Plus and forgiveness and income-driven repayment and public service loan forgiveness. So I guess all of that is one big question about what does this do, if anything, to kind of the way institutions are not really held accountable for price or outcomes in any real way, and whether us continuing to go down this path exacerbates that problem at all, and if so, what do we do about it? Just solve it right now.
I don't know how to solve it. I think that you're right that it does put more pressure on our systems of accountability. And if you consider students out there who are taking out loans and are unlikely to ever get value from those. That education and may never be able to repay those loans. So there are, however you want to define that, there are students out there that we know on paper are taking out loans that are likely to grow and grow and grow and not be repaid and be a significant burden. The plus side of income-based repayment is we are able to provide some insurance to those students. But income-based repayment alone is only one half of the solution, because then you're putting taxpayers on the hook for those low-quality loans. So, without question, we need to make sure that the loans that we're giving out are being spent at colleges where the loans are likely to be able to be repaid, whatever that means. Now, what makes this especially difficult now is, I don't know whether to blame it on the 70s, and many mistakes were made in the 70s. But we have had, we have a system of college financing now where if you say to someone, we're not going to give you a loan it's almost like saying to them, we're not going to let you pursue a college education. So we've gotten, so far down the road of using loans for access that it makes it difficult for us to make, hard-headed choices about which loans are likely to be good investments. And I think that's, ultimately doesn't serve students well, it doesn't serve taxpayers well. And I think we need to be thinking about different ways of subsidizing college.
And I think to your point about like this fear that we might have about doctors and lawyers borrowing tons and tons of money and then making these jobs at $300,000 a year and taking advantage essentially of this system, I think the trade-off is, there's a trade-off to be made there, right? Because at the very same token, like underlying all of this with income contingent repayment is an access and persistence set of goals, right? Like that's we're hoping that this helps people to get into college and to complete who otherwise wouldn't have the chance to do that. There may be some risk of graduate students or those who know that they will go on to make a lot of money taking advantage of this and paying the minimum and being done with it. But at the same token, we would hope to see these larger numbers of students that would make this worthwhile as in an overall trade-off.
And so there were some reforms talked about in recent years. At the end of the Obama administration, the administration put forward a proposal to kind of cap the debt that can be forgiven. So some of these concerns are mostly around kind of our willingness to forgive debt, and I think some of the most explosive claims are, people that make a ton of money having, tens or hundreds of thousands of dollars forgiven in the most extreme examples. Now, obviously, we shouldn't make policy to, curb the most extreme examples, but I think there was a feeling that maybe there was something real there that needed to be addressed. And so in your example, maybe if we cap the amount that could be forgiven or something of that nature, those were the proposals that were out there. And I'm wondering I think even the Trump administration had a proposal or in the campaign or something around capping or changing the way the forgiveness worked on student loans. And I'm wondering kind of where those are and whether those might be worthwhile pursuing.
So I'll say, I think there are ways in which some of the recent changes to income-driven repayment, you can cut back some of the forgiveness in those proposals. Some of that's already been done through the changes in the repay plan, and I know that the Trump administration put forward their proposal, which would rebalance things even further towards undergraduates. I think that those are good things in terms of the program's fundamentally supposed to be about undergraduates. I would say that, in terms of accountability, ensuring that the dollars are spent well, it's a very indirect mechanism. So I think it's important to be cognizant of not being excessively generous with respect to forgiveness or lavishing benefits on certain populations. But on the other hand, if the goal is to try and protect the integrity of the system and prevent institutions that might not be providing an adequate education, I think there's also a role for more direct policies because, just hoping that you're sort of changing the incentives of the student and the student then going to behave differently in the marketplace and that's going to change, the incentives of these schools. There's a lot of assumptions there. Yeah. And I think as a lender, the federal government is a lender in this space, and even with income-driven options, it's a nicer form of lending. There's just a responsibility to put policies in place that ensure that the worst-performing institutions aren't able to participate.
Any other thoughts on accountability?
Oh, well, with respect to some of the Obama proposals, there is a particular issue, I think, with letting graduate students borrow an unlimited amount of money and claim an unlimited amount of forgiveness. And
not unlimited, only limited by what the institution charges.
Only limited by what the institution charges, whatever the institution decides to charge for tuition and living expenses. And so, you had situations where there were schools, they know who they are, who were running a program where they could raise tuition to put the money back into their own loan forgiveness program and were essentially paying whatever portion of payments that were due by the borrowers under the formula, and the rest would get written off. And so they were running this program where they could essentially write their own checks, and students wouldn't pay anything, and taxpayers would provide whatever amount of subsidy. So I do think that that is a very rare circumstance today, but maybe once we want to close the barn door before the horse gets out and try and fix fix that combination of incentives.
Because that seems like a very rational response to, if you're like trying to figure out how to balance your books and take care of your students at the same time, and you realize that it's not illegal, and
right,
more power to you, right? Yeah.
Right. Well, it's like in that Simpsons episode where Lisa Simpson bought Al Gore's book that was titled "Sane Solutions, Sensible Tomorrows." It's a great rallying cry for us.
I think that's a great way to start any questions that we may have from the audience. We kind of covered a bunch of different topics here, from some of the origins of the loan programs that you saw in the film to some of the challenges of today and some of the solutions that are coming out from forgiveness and income share agreements. What other questions do you all have, if any, about for our panel?
Thanks. Hi. My name is Audrey Peak. I'm with the American Institutes for Research, and I work on income share agreements and income-driven repayment. Very excited for this panel here today. And I was wondering if you have any thoughts about the links between expanding access to income-driven repayment and bankruptcy policy. As you know, student loans, federal and otherwise, are not dischargeable in bankruptcy. If the purpose of expanding access to income-driven repayment and forgiveness options is to make it easier for borrowers who are struggling to move forward financially, can you see a future where borrowers who participate in income-driven repayment could have access to bankruptcy and discharge their loans?
I mean, I'll just say that I've always seen bankruptcy as an extreme form of the insurance we're trying to provide with income-driven repayment, and so I've just generally been of the perspective that student loans should be dischargeable in bankruptcy. I mean, maybe there's caveats that you can create around, like not within the first 5 years or something like that, but I've been sympathetic to that change for the same reason I'm sympathetic to income-driven repayment.
And we should clarify, I mean, bankruptcy for federal loans or private loans or both?
I would assume federal loans.
Federal. Okay. Right.
So, I mean, I am far from an expert in bankruptcy. I know that there are forms of bankruptcy that the debts aren't wiped clean, that you are entered into a structural repayment plan that is thought to be affordable, and so in that respect. But I think that more importantly, like, bankruptcy is a pretty painful process for borrowers to go through. It is very expensive. It has big impacts on your life. And so if we have a alternative system where we are able to say to people, we can promise that your student loan is affordable without making you go through bankruptcy, that is, that should be the goal. I think with respect to private loans, you have another rationale because for every borrower who goes through bankruptcy, you're disciplining lenders to make sure that borrowers are able to afford the loans. And so you are creating a marketplace where lenders don't have an incentive to create unaffordable debts. And I think that is very important. But with respect to the federal program, I think we ought to be thinking about how do we design a safety net that works without forcing people to go through bankruptcy.
Can I ask you, just while we're here, you mentioned when the creation of these programs, the idea is the default rate goes to zero, right? Do you think that we'll see that with this? Like, how long do we need to start to see, with income-driven repayment, the default rate go to zero?
I think that we have to be thinking about solutions that are not primarily based in policy.
Yeah.
We need to think about how are we communicating with borrowers, and the department will tell you that every student who goes into default, they've tried to contact 300 times. So maybe this is where your research is helpful. I think we need to think about the incentives we give our contractors, which are performance-based contractors, but we do not get the performance we want out of them. And we know that, for example, it's cheaper and easier for them to put someone into forbearance than income-based repayment. And I think we need to, I think Zakia's note about thinking about simplicity from the perspective of the student is really important, and there's a lot of work to do there. And maybe those are partly policy questions.
Any other questions?
So how do you think about the future of repayment in an environment where more and more learning is taking place outside of colleges and universities? How do you think about these programs in non-collegiate learning contexts? And do you think the principles of these new repayment mechanisms are going to apply to, I mean, the barn door is open right now on these new learning opportunities, and there's more and more experimentation going on. How are we going to fit these repayment options into these non-collegiate different forms of learning? Do they fit?
I think they can, in the sense that, I mean, one of the things that makes some of these new programs challenging is that they don't have a huge track record. And so, there's obviously been a lot of conversation about making the federal aid programs more open to these types of programs, facilitating innovation. And it always seems like you run into the same questions of how you sort of put the right checks in place to ensure the integrity of the federal program. And if you have some of these programs and they're willing to finance students largely off their own balance sheet with something that's like an ISA, where they're basically saying, you student don't pay us until you get a job making more than $50,000 or something like that. I think there's a huge opportunity to kind of incorporate a very strong risk-sharing element into all of this, which I think is beneficial and allows those programs to kind of prove their worth or eat a bit of their own cooking, I guess.
I'm going to start using that, eat a bit of their own cooking.
Yeah. This all has to be done in an environment of like the right consumer protections and everything, but I think if you can do that, then it could be a very beneficial thing.
Having the idea that it's interesting because the income share agreements in some of these non-traditional programs or boot camps or whatever are really, and I'm not an expert, you are, but you could imagine a way where the school or the program itself is on the hook if the students don't pay back. And so really it's like you don't succeed as a program unless the student succeeds, which is kind of the most basic form of accountability that you could imagine, and that's totally divorced from the way the student loan program works now. If enough students don't pay back and if they eventually default on their loans en masse, then the entire program loses its funding. So very different, but it's not on an individual basis where you're kind of thinking about how much you're charging and whether it's appropriate to charge that amount. And I think the decisions of all of the folks at the institution feel very divorced because they're not in any way responsible for whether the student pays back. Lumina Foundation has no position on these issues. I'm just musing about the ways in which this might work in a future SG here, so to mention. Other last questions? Now I see 2 questions, or 3, okay. You have to raise your hands high so Raymond can find you, okay.
Hi, my name is Kim Dancy. I'm with New America. My question is primarily for Professor Boatman, but anyone should feel free to jump in. I found your research really interesting, sort of about the decision points of students, whether or not to borrow and how that can vary and how loan aversion can affect that. I'm wondering if you or anyone that you know of has ever looked at the psychological impact of debt later on, like during the repayment process, and whether some of these alternatives to traditional repayment plans can sort of help alleviate some of that stress or anything along those lines.
Yeah, that's a great question, because we did, in undertaking this project, a lot of like a deep dive into some psychology and some sociology literature to try to better understand sort of borrowing behavior. Like, how do other disciplines besides economists think about borrowing? Because maybe there's some value in that. And so it was interesting because we read a lot about borrowing in psychology literature around, we read very little about education. And so there was lots to see about attitudes about debt and borrowing when it came to other, perhaps adult expenses, but we found very little related to education, which has only sort of furthered our desire to kind of better understand how adults think about this. Particularly, we were interested how they think about it on the front end, but this work has since developed into now thinking about it on the back end as well, and having to think about these repayment options. So I think that's an area for further research, is to see, we've had one system in place for a long time. We've added some other repayment systems over the years. I think there could be some interesting qualitative and quantitative work around how that impacts people's sort of borrowing performance after, or repayment performance after they've completed their degrees or stopped attending college.
Hi, my name is Reed Setzer. I'm from Young Invincibles. I was curious if we could talk a little bit more about ISAs. Specifically, I think when you bring up Purdue, bring up the work that the nonprofit is doing, it strikes me that there's a set of principles there, right? So it's a limited population administered by a nonprofit entity. It either nods at or takes into explicit the type of population you're trying to reach. There's low-income folks, people of color. Not exactly sure what the limits are in terms of the percentage of income. I believe Purdue is in the single digits for that specific population. Those all seem to be a set of principles that are good and will lead to good outcomes. I think people are concerned on the flip side of that, where ISAs aren't used as supplements to existing financial aid packages to get people over the finish line, but become direct competitors in this space run by larger for-profit companies that don't have any of those really principles in mind because they're driven by other things. So I'm curious if there is sort of a set document out there that articulates these principles and how those principles are possibly informing the discussion on Capitol Hill, as there's rumblings of how you would develop a regulatory regime for these types of products.
Yeah, so there's not a set document. There is a piece of legislation that when I worked for Congressman Petri, I wrote with him and with Senator Marco Rubio's office a piece of legislation to try and provide a legal framework for ISAs. It's since been adapted, and I did a lot of work on the most recent version with an eye towards where are the holes. I mean, this is a new financing product, and we really do want to make sure, I mean, to your points that, you know, all the people involved right now could be, are great, but I mean, it seems obvious that at some point people are going to come along and they're going to try and find holes in the system and ways to take advantage of students. I mean, and so, yeah, I mean, I think that document, and I'd be happy to talk in more detail about it, is right now, and this is the Messer-Polis bill, I can't remember the number, it was, you know, an attempt to put everything in there that we could in terms of thinking through the right consumer protection framework. I think there's probably more to be done, and I think it's worth thinking about because we want to get it right.
It's definitely a gray space. I think I saw one more from Joe Russo here. Yeah.
Thank you, Zakia. My name's Joe Russo. I'm one of those has-beens. I'm wondering whether you on the panel are aware of, or if there isn't, maybe there should be any research on how institutions, talking about accountability, how institutions create cost of attendance figures, which ultimately drive what the grad students are doing that you've referred to, perhaps what's going on and what are supposed to be low-cost opportunities at community colleges, where somehow students are leaving with tens of thousands of dollars of debt. One consideration might be limiting borrowing to what we used to call direct expenses, the bill. Well, that raises a lot of issues about commuters and part-time students, but the amount of additional cost involved in the cost of attendance calculation that is related to personal and transportation, perhaps, might be something worthy of additional review, perhaps, if we want to look at ways of reducing ultimate debt and ultimate default. That might be
This is a very lively conversation in the state of Tennessee right now, as they have moved to the free 2 years of, the tuition-free 2 years of community college for students coming right out of high school. And there has been a lot of conversation around the debate or tension between calling that free versus knowing that there still are other expenses that come with college. And there are very good reasons why you would want to market that as a free program, because you're hoping to get more students into college, and that branding alone is really important to this program, to be able to call it free. But in some ways, it's also not telling a complete picture because of the very things you mentioned, right? Like the transportation, the books you might have to buy, all of the other expenses that come with going to college. And so I appreciate the tension because it's been a very lively one in a state that is trying to say, we took away the tuition piece of this. There may be some other fees. There may be some other travel-related expenses. And how do you brace students for that fact in a program that's being marketed largely as free?
And we did have a conversation about this a couple of years ago, and I will say Braden Hosh, Sarah Goldick-Robb, and maybe Robert Kelchin, I think, the trio of those folks did a study on how colleges set cost of attendance in the same metro area, so not thinking about tuition, obviously, which is one piece, but the living cost portion of that, and found wide variation in similar metro areas. And I think they broached this question of whether we could or should have some kind of standard way of determining what it costs to live in a certain area. And I would go so far as there was no resolution. They just broached the question, and I don't know that people have thought more seriously about it. But also for the potential place of kind of setting a standard for what it should cost, even for like places that have expensive dorms that charge that amount. Should, if student lives on campus versus off campus, should you have access to, a large amount of student aid to have kind of an extravagant dorm experience when someone in a community college is right down the street in the same area and doesn't have kind of access to the same amount? Should you, is there parity there, or is there disparity there, rather that we should be concerned about? And so I think that's one study that was really interesting to me at least, but there's definitely more work to be done on that front. I'm going to close out here. I think we had a good conversation, and hopefully we can have some more conversation in the reception that I believe is just through these doors in the back. I would like to thank our panel for participating today, but I'm going to ask you to stay seated here, because I'm supposed to give closing remarks, but I feel like if you all leave, then people will want to talk to you and it will disrupt things. So I'm just gonna sit here and muse for a second, and it won't be that long, I promise. So I just wanted to thank you all for kind of engaging with us for a little while. I'm hoping that folks here, and maybe we're live streaming this, so others found this useful, the film series. I've been joking lately that although we do a lot to promote these films and to share them, it's just because we really think that they're a good resource. I don't get any kickback every time someone clicks the link. It's just I really think they're interesting and useful to policymakers. I was really, really heartened when someone on the earlier, I think James Bergeron said, every Hill staffer when they come should watch these films. So yay! I show
these films in my class.
And Angela told me this earlier. She shows these films to her class. So we've taken some of the burden from teaching off of her. Vanderbilt can cut tuition by like 50 cents because we're doing these films for Angela. So yeah, to the extent that you find them useful, please do share. If there's anything that you would like in terms of additional resources, we have viewing guides that go along with the films. You can find them on IHEP's website as well as Lumina's website. We today launched a brand new website featuring the films, which we think is useful. And just generally, I think as we move forward in thinking about policy for the next generation of students and for the current generation of adult students, what does that policy look like? We want to take into account some of the lessons that we've had from the past, because some of these debates about targeting versus simplification, about accountability in institutions and who gets aid and where they go, the balance between grants and loans, those things repeat themselves. So if we want to move forward as best as possible, we should probably do it with as much knowledge of where we've stumbled and where we've been successful in the past. So thanks for engaging us, and let's move into the reception. Thank you all.
Thank you.